Just when you thought you'd seen enough, well, I'm back again. David here, and I'm an ordinary CFA, CPA, just trying to help people tackle their important financial decisions. And home buying is super topical right now, as it seems COVID has really pushed the usual spring buying spree to now. And so we're sitting here in August and we're seeing a lot of real estate activity. And I'm not a realtor, but I think the combination of the nice weather and, with everyone's city sort of being in various stages of reopening, people are getting used to the idea of wearing a mask, social distancing, sneezing into their elbow, and all of those things are kind of showing an uptick in real estate, and people are back in the market looking at showings and just more comfortable dealing with the new normal. By the way, public service announcement, please wear a mask and like this video, one of which is scientifically proven to reduce the spread of COVID-19. Anyways, here in Canada, we're seeing a lot of home sales, and Canada-wide, in July, there were 62,355 homes sold, and that is a record for as long as they've been counting the data, which is about 40 years now. And you see similar patterns in the US, with the most sales since December 2006, and the largest month-over-month increase in home sales ever. Couple that with the lowest July supply of homes since they've been taking the survey down in the US, which is 1982, and well, things look like they're going to be a little crazy in the home buying market for a little while. And as many would-be home buyers are looking for a home in this environment, well, they're all going to come across the same financial decision, and that is, should I get a fixed or a variable mortgage? Well, today we'll make that decision a whole lot easier. So we'll unpack the basics of choosing a fixed versus a variable mortgage and what that really means. We'll talk about the pros and the cons of each, and I'll give you my recommendation on what I think makes the most sense at this point in time here in August 2020, so stay tuned for that. So let's get started. Understanding really what a fixed or variable rate mortgage is easy enough. And understand that, a mortgage is just a bank is lending you money to buy a home. And for the privilege of you getting access to their money, they're going to charge you interest. And you've got two options here. Most banks will let you pick between a fixed rate, which is one that doesn't move, and a variable rate, which does. And what that means when the interest rate changes is that whatever schedule you have for your mortgage payments, whether that's weekly, bi-weekly, or monthly, that means that the mortgage payments themselves are going to change. So let's start with fixed rates. So a fixed rate is fixed over the term of your mortgage. And it's not to be confused with the amortization of the mortgage, which is what people talk about when they say they have a 20 or 30-year mortgage. That's the amortization. The term is usually between 1 and 5 years, and that's basically how long this single bank is giving you their money for the house. Once that term is up, you'll have to renew your mortgage with some other bank. So the term is usually between 1 and 5 years, but most people choose 4 to 5 years here in Canada. So when that term is up, you're gonna have to make the fixed or variable rate decision once again. And if you kindly like this video down below, I'll advise you in 5 years' time what to do then. So that sums up fixed rates. It doesn't change. It's one interest rate that you pay for the term of your mortgage, and that's it. Make sense? So variable rates are rates that can change, and they're tied to a lending rate. Here in Canada, that rate is usually Canadian prime. And people talk about variable rates as prime plus or minus a certain number of basis points, or 1/100th of a percentage point. So if prime is 3%, then prime minus 50 bips means you have a 2.5% interest rate for your mortgage. So today prime is 2.45%, and that's nearly the lowest it's ever been. So prime can change at any time, but typically it changes once a quarter when the Bank of Canada sits down over tea to decide everybody's financial future. So as prime moves, so do your monthly mortgage payments, and that is the key component of a variable rate, that they change, and that changes your obligation. So let's have a quick statistic. So at this point, 74% of mortgages are fixed, and 21% are floating, and 5% are a combination, a little bit of fixed, a little bit of floating. So let's talk now about pros and cons. In general, in a declining interest rate environment, floating rates or variable rates are less than fixed rates. So remember, less interest means less money owed to the bank, and so your monthly mortgage payments are going to be lower. So we've been in a declining interest rate environment for like the last 30 years. So people who have picked variable rates have historically, over that period, done better than those who have picked fixed rates. So there's a key con. History says that fixed rates are going to be more expensive. But that said, there's two sides to every coin, and so once interest rates start rising again, you're really going to wish you picked a fixed rate, because that means your variable rate mortgage is going to cost more. So as that interest rate keeps rising, that means that your monthly mortgage payments are going to keep increasing as well, which could result in some pretty tight budgeting. And small interest rate increases can really add up. Put it this way, if you have a $500,000 mortgage and mortgage rates increase by 0.5% or 50 basis points, well, your monthly mortgage payment is going to increase by $131 a month. And that's a 0.5% increase. If it increases by a full percent, well, now we're talking your monthly mortgage is going to increase by $267 a month. And that might not sound a lot. Well, what's a couple $100? But if that's every month, I mean, Ipsos says that 48% of Canadians are within $200 of financial insolvency. So I think we can all agree that there just isn't a lot of room in the average Canadian's budget to afford increasing mortgage payments. So with a fixed rate, what you pay today for your mortgage payments is not going to change throughout the term of your mortgage. So if you lock in a 5-year rate that's really attractive, well, the cash outflow you have today for your mortgage at, call it $2,000 a month is going to be the same $2,000 at the end of your term 5 years from now. So you've got that certainty. And that makes monthly budgeting a lot easier. Once you know exactly what your outflows are going to be, well, that's just a lot easier to know if you've got room for that extra vacation or to buy a new phone or whatever. And that sense of stability of knowing what that outflow is going to be can bring a lot of peace of mind, and that's understandably hard to quantify. So that's a big plus for the fixed rate mortgage. Now, when it comes to actually changing your mortgage, you can usually convert a variable rate mortgage into a fixed rate mortgage. So if you start to see rates increasing and start to get stressed out about it, usually you can swap that out for a fixed rate. The opposite is not true. With fixed rate mortgages, you're locked in, and that whatever you signed up for, 2.5%, whatever that number is, that it cannot typically be changed over the term of your mortgage. Well, that is without some pretty nasty prepayment penalties. So now for the juicy part. What makes sense today in August 2020? What should you do? And so history says that for the last 30 years, floating rates or variable rates have been the better choice, and you would have saved money. And I'm not an economist, so I'm not going to attempt to predict the path of future interest rates. But with interest rates the way they are today, the best variable rate and the best fixed rate, the spread between those two is now only about 0.14% apart. And what that means is that a variable rate does not save you much money relative to a fixed rate in today's environment. And so if there is even a single interest rate increase over the next 5 years, and interest rate increases, by the way, are typically done in 0.25% increments. So if there's even just one of those occurring, well, suddenly your variable rate mortgage is going to be more expensive than what you would have otherwise locked in with a fixed rate. So is it likely that rates are going to rise 0.25% or more in the next 5 years? I don't know. Ask an economist. The short answer is that it is very likely that the Bank of Canada will raise rates at least once in the coming 3.5 years. Benjamin Tal, Deputy Chief Economist of CIBC, said in an interview, "We have to remember that we are at emergency rates, and a reasonable scenario is that the emergency will not last for 3.5 years, given the nature of it." So that's a pretty compelling case for today's fixed rates. But that said, if you want to gamble a little bit with volatility, you could go for a fixed rate and opt for a shorter term, maybe just 1 to 3 years. Some of those rates right now are very compelling. That said, you'll be back to gambling on interest rates when the term is up. So that's a risk you'll have to take. So at this point, I personally would not bother with variable rates. I think the fixed rate mortgage is the way to go, and the mortgage is ultimately most people's single largest cash outflow. And so having that certainty, that peace of mind, and knowing exactly what you're going to pay on a monthly basis for the next 5 years, well, that's a great feeling. And a few basis points that you might save now, but probably not later, is not worth that trade-off in my view. It doesn't feel like interest rates are going to be rising anytime soon, but 5 years is a long time, and clearly with COVID coming out of nowhere at the end of late 19, well, a lot could change in a few months. If they come out with a vaccine in the next 12 to 18 months, which is what they're currently predicting, well, there's a good chance that the economy and things will start to normalize, well within the term of any new mortgage you're signing for today. When that happens, interest rates are likely to start normalizing too, and so that's something you're going to have to watch out for. But look, picking a fixed or variable rate, like most financial advice, it does depend on your financial situation, and so if this is your first home, or if this is your 5th home and you already have a portfolio of properties, you might make a different decision. Like for example, if you already have a few fixed mortgages, well, you might be willing to switch it up and try a floating rate. That said, with spreads as narrow as they are right now, my clear choice at this point is a fixed rate. But look, that could change at any time. Interest rates are always moving. But look, if you're not sure what to do, it's your first home, go for a fixed rate. It's just going to make your life a lot easier for the first couple of years. And ultimately, whether you get 2%, 2.5%, These interest rates are among the lowest we've seen for the last few decades, and so it's a good deal. Well, that wraps up the video. Thanks for sticking around this far. If you're out house hunting right now, I wish you the best of luck. It's a stressful time already buying a house, and it's even more stressful with COVID and everything else going on, so good luck. If you like my content, as usual, please drop me a like and subscribe down below. Believe it or not, I've got a lot more to say, and so stay tuned for the next video coming up soon. Take care.